What is real estate? Real estate is a property. So property refers to anything that can be owned. And in terms of property, we have tangible asset and intangible asset. So tangible asset, which are the physical asset you can actually be owned. It can be real asset like the gold, the real property, the car, or it can be your personal asset like the clothes, the notebooks, things like that. And intangible asset are the non-physical asset, like the stocks, the bond, and the mortgage lease, which is also a type of asset, but you cannot observe it. Most time it's kind of a contract. So first, what is the nature of real estate? Real estate is a tangible asset. It includes the raw land. So if you say I own this property, it means you own the land where the property is built on. When you purchase a single family property, they will tell you not only like the size for the living area, but all the size for the lot size, which is the total land value you are going to own. And it also includes improvement to the land. Improvement to the land means a component which are necessary to make the land suitable for use. For example, if you want to build some structure on the land, you need to fill the land if it's not flat. And you need to install sewers and other utilities like electricity and the like internet. And also you need to develop roads and driveways to make sure this site is accessible from the other areas. So all this improvement to the land is also part of real estate. Real estate also includes the structure, which are the improvement on the land, such as the buildings you build on the land and the fences you install on the land. As an intangible asset, real estate refers to a bundle of rights. So real estate is both a tangible and intangible asset. The bundle of rights could include possession, use or enjoyment, disposition, exclusion, and all these rights can be unbundled in many different ways. Now let's look at some examples for each of these rights. So the first one, possess and control, it refers to your right to own that property. For example, your right to use this property as a collateral to have a mortgage issued, and your right to rent this property out and receive the rental income. So that is the lease right. And you can impose covenants or conditions on the renters, what they can do within this property and we are prohibited. And you can grant easement to the other people, and you can also build or remove structures on the land. You can remodel the property, and you can build extra rooms on top of the land if you obtain permit from the government. So that are related to the possession and control right. The second right is the use and enjoyment. So which means you can really use this property as a residence, being an owner-occupied property, or you can use this property as business. For example, if you are the real estate broker, and you can use one room as your office. And you can plant on the farms, and you can do the mine or drill for oil, for all the resources under the land. And you can also use this place for recreation. So that is one type of right you enjoy as owner for this real estate, use and enjoyment. Disposition refers to you have the right to sell this property on the market, and also you have the right to refuse to sell this property to certain people. And you can also give this property as a gift. You can also leave this property at a will to some people, and you can also abandon this property. And exclusion maintains you have the right to decide who could visit this property, like you have the right to maintain privacy for the property, and put non-trespass restrictions on the other people on this property, so they cannot just come into this property or go bypass through the private road. So real estate are both a tangible asset, refers to the land, the structures, and all the improvement under the land. It is also an intangible asset, refers to a bundle of rights. For example, you have timber right, you can farm on the land, and you have the right to build homes. You have the right for all the resources under the ground. You have a right to access and you have a right to sell. So that is the nature of real estate. So as an industry or professions, there are a lot of job opportunities which are related to real estate. For example, the first one is real estate brokerage. We know like real estate market is a highly intermediate market. That mainly because as an average person, we do not involve so frequent real estate transactions as you trade the stocks or bond, because real estate property is very expensive and the commission fees, transactions fees is really high. Because we are inexperienced buyers and sellers in the real estate market. So a lot of times we have to rely on those experts, those real estate brokers or salesperson to help us to succeed in the certain process on the real estate market. So there is a large team about real estate broker industry. And brokers, they usually charge a percentage of commission based on the successful sales. If you want to sell a property and you need to find a listing broker who will try to list your property on the multiple listing service platform. So which a platform where all the listings will be shown to the other potential interested buyers or buyer's agent. So it's an information sharing platform. And you need to pay around 6% of the commission to the listing agent if the transaction is successful. And then the listing agent will share a certain percentage of the commission to the buyer's agent who bring in a buyer to complete the transaction. So that is brokerage. The second is development, which refers to the real estate developers need to purchase the land and make a decision on what type of buildings to build on the top of this land and what are the future cost and benefit analysis on this land. And we also have leasing, like you first came to the campus and you need to find an apartment to live. So you need to sign a lease contract, which specifies the right to enjoy, to live in that apartment. And also you have to pay monthly lease to the rental office. Property management refers to like the property managers who try to help the owners to manage like the daily operation of the property. Like it includes like the multifamily properties, apartment buildings, office buildings. Asset management. As we talked about earlier, real estate is a very important component for the wealth portfolio for lots of households. So in terms of asset management, how to allocate your investment allocation in real estate versus in the stock market or in other investment. And real estate law, we have a lot of like legal experts who works on develop real estate law and legislations. Real estate appraisal, if you need to buy a property and you want to get a loan from the bank will ask you to provide evidence. What is the current market value for this property? Or what is the appraisal value for this property? So in order to obtain a mortgage contract, we always have to have appraisers to come to visit the property and generate a copy of appraisal report. So that is the real estate appraisal. And also from time to time, and the government will send appraisers to different households, evaluate the value for the property to determine the property tax for the property. And market consulting and counseling related to the investment in real estate and the trend in the real estate market. We also have planning, which is more related to the government jobs, like the urban planning. How do we decide like which areas we will develop as a commercial focus area, which areas we will like develop more residential buildings over there. And the real estate is a highly regulated area and industry. So we have a lot of government regulations related to real estate, as well as taxation. Property tax is the major income for a lot of local government. And there are also housing assistance programs to help those in need of housing, like affordable housing and subsidize for those people on the housing need. And mortgage finance is very common if we think about it. The property is really expensive. It's so hard for us to purchase a property with 100% of cash. So majority of the time, we do finance a property with a loan from the bank. So we need a lot of experts to help us on construction finance and long-term finance to obtain a loan from the bank. And investment management, which again refers to how do we allocate different resources among different types of investment categories. So as an academic field, real estate market is also different from the other market. We have traditional market where the goods and services are produced. So the question on the traditional market is what to produce and what to consume in that market. And we also have financial market. So financial market mainly solve the question about when to consume. Shall I consume this today, or shall I save the money and consume in the future? And we have real estate market, which mainly refers to where is the location, where should I build, where should I live? So first, let's look at about the financial market. So financial market is about the timing when to consume. Let's suppose there are two individuals, A and B, each has $100,000 now, but they have completely different preference. So let's assume A prefers to spend in the future, and B always prefers to spend all the money now. Also, let us assume the market interest rate is 10%, which means you can borrow or lend at 10%. So what would each of these individuals do in this market? If you look at what A will do, because A prefer to postpone the consumption, so A will just save the $100,000 and put it in the bank or invest it somewhere to make a 10% return and consume it in the next period. And at B will always prefer to spend all the money now. So B will spend $100,000 now. What if we have an individual C who would like to consume $50,000 now and save the rest for it? So for individual C who will consume $50,000 now and spend $50,000 times 10% return in the future. So if we look at this graph here, on the x-axis, we have the dollars now, which is how much they will spend at today. And we have the y-axis, which is dollars next year, how much they will have by next year and consume by then. So as this graph shows, A, B, C, they have completely different preference. So B can consume all the $100,000 today. And C can consume $50,000 today and invest another $50,000 at 10% return and consume it in the future. And A will prefer to invest all $100,000 at 10% return and consume $110,000 in the future. So this is what financial market allows us to do. So the first result, financial market will allow us to postpone consumption. We can save the money, invest money, and to consume it in the future. Now let's suppose both A and B, they will receive $100,000 at the end of the 1 year. So as A would always prefer to postpone consumption, and B want to consume as much as possible today. So we know that B will receive $100,000 at the end of 1 year. So what B can do is B can still consume today by borrow money from the bank at 10%. So how much money B can borrow, it depends on how much money B can return to the bank 1 year later. So the maximum amount of money B can borrow today will be $90,909. So we see this graph here. Although A and B, they are not going to receive any money today, but B can still consume $90,909 today. And at the end of 1 year, B can just take the $100,000 he received and pay it back to the bank and make 10% interest payment. As A always prefer to postpone the consumption, So A will have zero consumption today, but $100,000 consumption in the future. So what this paragraph tells us is the second result. Financial market can allow us to bring consumption forward, which means we can consume today, even we do not really receive any resources today. We use the future income as a promise to borrow money and consume today. So financial market, it helps people to make the decision, when do you want to consume and when do you want to invest? Real estate market is about where. It's a choice of the location. So we choose the location for ourselves. We choose the location, where do we go to school? We choose the location, where do you want to live? Like which neighborhood, which city do you want to live? We also choose the location for the other people. And like the first picture here is a Great Wall in China, and which was firstly built as the infrastructure for the wall to fight against the other people. And the second is a picture for the prisoner. So real estate, the most three important word is always location, location, and location. Real estate market can be categorized as user market or capital market. So user market, we also call it space market. That is a market where real estate property or the space being transacted. So in this graph here, on the left part, it is what happens in the space market. So in the space market, we have supply of space. So we have developer who develop new constructions. We have sellers who sell these properties, and we have landlord who rent this property on the market. So we have supply of space. We also have demand of space, who spend money to exchange the right to use certain properties. The demand including the tenant who are looking for a place, the buyers who are looking for a property, and also buyers who are looking for construction by the new developers. So in the space market, we have supply of space who provide physical space for this market, and we have demand of space who is willing to pay money in exchange for the right to use the space. So that is what happens in the space market. In the space market, we still have like different focus: office building, multifamily buildings, apartment, shopping centers like hospital, and other different types. And the second part is what we call the capital market. So for the capital market, it's different from the space market. In capital markets, we don't really have the exchange for the property and the dollar amount to use the property. So in the capital market, it's mainly used to raise fundings for the space market, because in order to develop space, provide supply in the space market, we do need to have a lot of money to develop these real estate properties. So in the capital market, we have supply fund in the capital market, which provide cash flow into the space market to develop more properties. And also, we have this demand of fund who need money from the capital market in order to develop properties. So in the capital market, we usually see the investment funds, insurance companies, pension funds, or risk companies. Those are the major institutional investors in the capital market who provide cash flows or the financial resources to the physical market to develop new real estate space or asset. So for the user market, or what we call the space market, that is a market for the physical real estate. Sometimes we call it space market or the rental market. So in this user market, we call it the buyers. They receive the right to use the space. So the buyers, we have quotation mark here because buyers can mean the buyer for the property or the tenant who are buying to use some property. And we have sellers exchange the right to use space for money. The sellers can be the seller of property who sell this home, or the sellers can be landlord who lease out the property in exchange for the rental income. So in the user market, it's the demand and supply in the user market which determines the rental rate. like the rental rate for the lease contract or the price for the properties. So on the demand side for the user market, we have the individuals, households, or firms who require space either for their own consumption or for the production purpose, like individual or household who are looking for purchase of property or who are looking for rental of property, and firms who are looking for rental property like office buildings, apartment buildings, and industrial buildings. And on the supply side, we have real estate owners, the sellers, the landlord, or the operators who will rent a space to the tenant or who will sell the property to the tenant. So what we can say, like both the demand and the supply side for the user market are very specific to the location and building types, which means the user or the space market are highly segmented compared to the nationally integrated market. If we look at like 3 examples to understand how real estate are different from the other asset, for example, first look at stock shares. Think about you invest in shares traded on the stock market. So all the shares will be homogeneous. If you want to invest in Amazon stock, it doesn't really matter you live in New Jersey or you live in California, you are traded the same stock. There's no price dispersion, it's the same price for the same stock, even you are at different location. And there's one market where the stock has been traded, like it's a public market. So that is the stock shares. Now let's think about the gas market. In the gas market, there is some heterogeneity regarding the quality of the product. Like you may feel like certain gas station provide a higher quality product than the other gas station. But there are low price dispersion. We can still explore price differentiation, like in the gas station, even within a city, but the difference is really small. There are many different brands, many different gas stations, but it's an interconnected market. The price variation will be small. There are price variation and there are also quality variation, but that will not be really significant. How about the housing? How about the real estate market? So for the housing market, it's really different from the gas market or the stock market. It's highly heterogeneous. Heterogeneous means it's really very different. Let's think about the 2 properties, and they can be really different in terms of lot size, living areas, number of bedrooms, bathrooms, and the exterior outlook, the condition for the property. Even we can argue, hey, look, these are 2 buildings next to each other with exact the same floor plan and by the same developer. They may be very similar or the same when they were first on the market, but still they have different location. They sit on different lot size. And after a few years, when the property has been occupied by different owners, because of different maintenance and upgrade, the property can become different. One housing property is really different from the other one. And there are high price dispersion. Across the country, we can see the price level for real estate property are really different. And even within a city, like in different neighborhoods, the price per square footage can be really different, depending on the amenity of the neighborhood, the school quality, the location, convenience, as well as attributes like whether you have a swimming pool or you have like a waterfront view. And housing is money isolated market. Housing market is really specific to the location. So if you are a real estate broker in California, you may not be successful to buy and sell property in New York because you do not have the local knowledge and expertise about that specific market. And in terms of the price level are quite different across different neighborhoods, and price level are really different across different property types as well. So what we can say is housing market is really different from the other type of product. Housing market has high heterogeneity. They are really different products, different from each other. There is high price dispersion, and it's money isolated market. So this graph here just show us the K-share housing indexes before the 2007 housing price crisis. So what we can read from here, like the dark black line is kind of the composite 20 areas indexes. And then we have different areas like New York, Washington, D.C. So what this graph can prove is we have many isolated housing markets, and the price level in different housing markets can vary significantly from each other. So what we can say is the price increase prior to the financial crisis are really different. In some areas like Detroit, we observe, or Cleveland, we observe really flat price increase. So the house market price didn't really appreciate that much. But in some other areas, like if you look at like the housing price in Los Angeles, in Miami, in New York, in Washington, D.C., you see a significant increase in the housing price indexes prior to the financial crisis. So the housing market are quite segmented market. They are isolated from each other. The price level are very different, and the price appreciation, price change are really different. So that is the user market. How about the capital market, where there is supply of fund for the real estate market and demand of fund for the real estate market? So we have the 4 different parts for real estate capital market. We have private or public capital market. So private market means you directly held the ownership in the real estate. Public market means you indirectly held, like you can purchase shares of REIT companies. You do not really own this actual property, but the REIT companies can invest in that property. And you can be active holders. You have ownership shares in that property, or you can be debt lenders. You can be debt holders. You can lend money to that property. Now let's look at 4 different parts for the real estate capital market. So for the real estate capital market, we have 4 different types. So the first type, we have private equity. So the private equity here, that is solid red line, which means you directly invest money into a real estate property. You can purchase a property directly, privately own a property. That is called private equity. Or in the private market, instead of purchase that property, you can be a debt lender. You can lend money to someone who are interested to purchase the real estate property. So that is private equity. You lend money to some other people or some other companies who then invest in this real estate property. So you are private debt holders for this real estate property. And so both private equity and private debt, they do not go through a public market, the public stock market. And the public equity and public debt market. So for the public equity market, what happens is, as an investor who want to invest in real estate, you do not purchase this real estate directly. Instead, you purchase shares of publicly traded real estate companies like REIT companies. You purchase like 100 shares of the stock for a REIT company, and this REIT company use all the money raised from the capital market to purchase directly about the real estate properties. So now you are public equity holders for this real estate property. You do not own it directly. You own the shares of the companies. The company invest in this real estate property. So as equity holders, these REIT companies, they receive rental income from their investment in the real estate asset. And as a return, they distribute this rental income as dividends to the equity, the shareholders in the public market. So that is public equity. And then we have public debt. So for public debt, most of the time, it refers to mortgage-backed securities or mortgages. So as an investor, you purchase the shares of publicly traded mortgage-backed securities in the capital market. So it's kind of stock, you purchase it on the capital market. and the money they receive was lended to these real estate companies. So these real estate companies spend money to purchase real estate asset or to purchase the mortgages on real estate asset. So those are the 4 channels we can raise funding for real estate investment in the real estate capital market. So what we can learn from here is for the private real estate market, we don't have a centralized market. We don't have like a stock exchange where we can all share the information and the same shares have been traded with each other. For private real estate market, it's really decentralized market. It's local communication, local information on a specific property, and it's a group of buyers who negotiate with each other about the offer on these private deals. So the private deals on commercial real estate, most of the time is not publicly information available to the general public. And the assets, they are traded in the private transactions. So we don't have so many news. It involves more about like negotiation and offering and counter offer process. And it's very common for the whole asset, so the entire piece of asset to be traded in a single transaction, which we call indivisibility, which means you cannot cut this real estate asset into small pieces and sell them differently. Most of the time, it's an entire building, entire property will be sold in one transaction. It is less liquid because it's not common product as the stocks traded on the public market. Each real estate property are quite different, are quite unique from the other properties. It also involves a large investment to purchase a piece of commercial real estate property. So the market is less liquid. And also, we don't have so many active buyers and sellers in the private commercial real estate market to improve the liquidity in the market. And there are really high transaction costs. If you can think about the value for the commercial real estate properties is multiple $1 million, and that can involve the higher transaction cost in terms of the commission rate. And for the public real estate market, it's really different. You are not really purchase directly of real estate asset. You are purchase a small homogeneous unit of ownership in the asset traded in the public exchanges. So you are purchase like the share of the REIT companies. In that sense, it doesn't matter whether you are in California or you are in Boston, you are purchase and sell the same shares of the companies. It's the same as the other stocks. And there are many buyers and sellers in the market. It's publicly traded shares. And the price quote are available for all to see, the most up-to-date, up-to-second price for these REIT companies. And you can just place your order through the brokerage account. And it's characterized by a high degree of liquidity. If you want to sell a whole piece of commercial real estate, that probably takes a very long time to find a good buyer who is willing to offer a great price. But for the REIT stocks, if you want to sell it, you can just sell it in a second in the stock market. So the public real estate market provides the current income for you as all these firms, they invest in the real estate properties and also help you to achieve this diversification benefit. Instead of put all the money or raise a lot of money to purchase one asset, you are able to invest in REITs specified in office, in apartment, in retail. So in that sense, you kind of diversify your portfolio in real estate investment. And also you can achieve that diversification among different geographic areas. Like you can invest in REIT stocks, which focus on different locations across the country. So if you look at who are the players in the 4 groups for the capital market, first for the private equity holders, those are the investors who directly spend money to purchase a whole piece of commercial real estate property. They could be individuals, all the firms or institutions who are interested in acquire a specific real estate property who have no local knowledge for the management and enough financial resources to complete the deal. And for the private market, the debt lenders or the debt holders, they could be banks or private lenders or insurance companies. They have a lot of resources or cash to invest. But instead of purchasing that property directly, they prefer to lend money to that investors and receive interest rate as a return. And for the public equity holders, they do not directly have the ownership in the real estate property. They indirectly hold the shares of the other companies who invest in real estate property. So this includes the publicly traded real estate companies or the equity real estate investment trust. So those companies, they invest in real estate properties and then they issue shares in the publicly traded stock market. And for the public debt market or public lenders, we have mortgage rates or mortgage-backed securities. So instead of purchase the shares of REITs, become equity holders, you can purchase shares of mortgage rates or mortgage-backed securities and become the public debt holders in the capital market. So in this case, you do not really enjoy the profit or the price appreciation for the real estate properties. You just receive interest income as a return for the debt holders.